So, hey everyone, my name is Alex, and in this call, I'm joined with my co-founder Conrad, as well as our outreach member Neil. We run a group called West Bank Financials, where we focus on boosting financial literacy among the youth. And one way we do that is through hosting podcasts with amazing people in the financial field. Today, we have a really exciting guest. We're here with Mr. Brian Murphy. So you've obviously had a very successful career. Something I was curious about was if you could go back to your high school days or college days, is there anything you would change of how you approached your career in finance or just life in general to like anything you wanted to change? Yeah.
It was interesting. In high school, I was entrepreneurial. The way I saved my money for college was I started a painting company.
Mm.
And so I would hire my friends and train them, and I would go out and find the business and did very well. We were able to go ahead and paint a lot of homes. We were in Connecticut, so the value of the homes was high. And after paying everyone, I was routinely banking $1,000 to $1,500 a week. And so I was able to, figure out how small businesses worked and decided that I really enjoyed business and that would be an interesting path for me. When I got to college, I studied finance and really enjoyed it. And I thought, okay, I think what I'd like to do, and I saw friends and the parents of my friends, and I thought either I want to be an asset manager, a venture capitalist, a buyout guy, or be a consultant. I had ADD tendencies, and so I knew that I didn't want to like research cancer for 35 years. That I just liked, really hard charging, fast assignments where you could work, 60, 70, 80 hours a week, work real hard, get it done, and then move on to the next thing. But I had two weaknesses. One, I was pretty shy. And so I felt it would be very difficult for me to be a good salesman because I really didn't like to talk to people I didn't know. The second weakness that I had was I couldn't get on an airplane without getting sick. I had very bad motion sickness. And I'm thinking, well, if you want to be a consultant or if you want to be an investment person, you probably need to fly and you probably need to be able to make a lot of good presentations. And so I went to the Career Development Center and I took their aptitude test to see what they would recommend that I do for a career. And the results were that they suggested that I become a mortician because you don't have to talk to dead people and you didn't have to travel very far. And I just thought, that's just nothing that interests me. It's a great profession for some people, but it was not the profession I was interested in. So then I had to say, okay, if this is what I want to do, I have to actually change who I am. I have to change my my kind of physiological makeup. And so it took me 4 or 5 years before I was actually able to fly and read and eat all at the same time. But I started by just keeping my eyes closed. And and then after I finally was fine with that for a year or so, then I would actually open my eyes and I would then I would drink some fluids. But it took years before I could actually read a book on an airplane or to do that. And the way that I trained myself was I was commuting to New York City and I would ride backwards on the train. And that would confuse my body, but I'd get used to it. I'd ride in the back of the car with my kids. My wife would drive. I would start doing emails or read a book. And so I just kind of did things to strain my body to make it more used to it. And now I've been to 99 countries. I've flown 6 million miles. I've been around the world 260 times. I almost lived on an airplane for 20 years. And I was really grateful that I was willing to make that effort to change because I had a wonderful career, but I never would have had it if I didn't force myself to get on airplanes and figure out how to fly.
I see. Seemed like you had to overcome a lot of challenges to reach success in your career, right?
I think that anybody who's successful has to figure out how to overcome challenges. We all have our own personal challenges. We have our strengths, we have our weaknesses, and figuring out what they are and figuring out how to make our weaknesses less weak and sometimes even make them strengths is part of being successful. And I think for me, those were the two things that I really had to work on. I remember when I volunteered to be in charge of all of our fundraising for our funds. My partners and I would sit down and we'd say, okay, how much money did we raise last month? And we were trying to raise a $50 million fund. And, it's like, well, none. Okay. How many meetings did you have? How many phone calls did you make? Well, I did two, but I was really busy. I had all these other things that I had to work on. We all had really good reasons for why we weren't marketing because we had existing clients and they were advisory clients. But you don't grow if everyone's making excuses. And so I came home and I told my wife, I said, even though I'm probably the worst salesman in the firm, I want this firm to grow. This is what's good for our team. This is what's good for our firm. This is what will be good for our family. So I'm going to learn to be a great marketer. And so I would lock myself in my office and I would just go hard for 3 or 4 hours and then I'd be completely exhausted. I might be sweating and go home and take a nap. It took a lot out of me, but I figured out how to do it. And over time, my win rate got better and better and better. It became easier and easier and easier. I've been given thousands of presentations. I still get butterflies when I give a presentation, but I think that kind of keeps the edge. You're always prepared because you know that you gotta be able to do it in your sleep, and that made me a better salesman. And as a result, we were able to raise over the years many dollars of capital and grow a very big firm.
It's very impressive how you're able to turn one of your what was originally a weakness strength and overall build success. Very impressive. Anyways, leading back to the educational aspect, I was wondering how attending a traditionally target finance school like Columbia sort of propelled and benefited your career in finance, and if it also helped you acquire like internships or jobs coming out of college.
One of the benefits of the Ivy League is that they're highly regarded credentials. You can learn and get a great education at almost any school because it's a lot of how much you put into it. And there's a lot of self-reading. There's so much information on the internet. You're going to have smart peers and you're going to have at least some good teachers. You can get a great education anywhere, but it increases your chances of being around the smartest people when you go to a school that's incredibly selective. They're super expensive, but the credential usually pays for itself if you want to go into certain very high demand and high paying industries. Many people who went to Columbia wanted to be investment bankers. It kind of was known as a mill for generating lots of investment bankers. All of them came and interviewed on campus. And um, in my class, we had, a significant, probably 2/3 of the students had internships on Wall Street, and almost all of them, because they were really capable, ended up getting job offers. But there are things that happen in your life that you can't control. Um, I was in graduate school in 2000 and I'm sorry, 1986 and 1987. And you might be familiar from your research what happened on a Monday in October
The
in,
crash.
2000, in 1987. Yeah, Black Monday. And it was crazy because every investment bank, but a very few, so most of them canceled their hiring programs. All the offers they had given to their interns who had worked really hard, almost all of them were canceled. They canceled their analyst programs. They canceled their associate programs. They cut staff. And so there were like 700 of my peers at school that had investment banking offers that disappeared. And I think there were only 5 or 6 of us that ended up actually keeping our job offer and going to work at an investment bank as a result. So it was a very tumultuous time, and not everybody was able to get their dream, which was I came here so I could be an investment banker, and there are no investment banking jobs, and so they went into other industries. And I know some moved into investment banking when the market cleared and people started rehiring. But many of them ended up in pharmaceutical sales or other management positions in other industries, and they've had wonderful careers. So there is no one exact job path that is best for you. You'll learn a ton, you'll enjoy many things, and you just kind of figure it out as you go. I don't know anybody who had a straight up career path. Most of them zigzagged along.
Yeah, we noticed that, and that with a lot of other finance professionals, they started off in like investment banking, or like private management, or something of that nature. Anyways, you mentioned that one of the benefits of going to school at Columbia is that you were surrounded by a lot of like-minded and overall smart people. I was wondering how that helped you build a network overall, and if you're still in contact with the people you met at Columbia.
Look back with some of them. One of the things that I quickly learned as we started our study groups, as we started taking tests, I was a top student at my undergraduate, and I was about an average student at Columbia because it really was the best of the best. And so I was married, and then I sat down with my wife and I said, if our goal is for me to be in the top 10% of this class, you will never see me. I'm going to have to get up at 6 in the morning. I'm going to stay at the library till midnight. I will have to study all weekend. We're not going to go on any trips. We're not going to do anything fun. But if that's our joint goal, then that's what it's going to take, because half the people in this school are smarter than me. And so I'm going to have to outwork all these people in order to get to there. And we concluded that, you know what, we can probably place in the jobs and the careers that we wanted to if we're in the top third. And so that became our goal. Instead of going for the top, we said being in the top third is plenty. And that way we'll end up having a better time. Not going to play around a lot, but we'll get to play around some. And at least we were able to go, away for the holidays and go see our families and things like that. So you just kind of had to have a realistic view. There were people who were so much smarter, if they stepped on the gas at all, they were going to smoke you, for sure. There are people that I was smarter than them, and if they worked that 100 hours a week, they were going to pass me. And so it was really kind of a jockeying for who wanted it more. And we decided, that would be an appropriate level of sacrifice. But I followed some of my peers, and they've had wonderful careers. Some have had really, really successful careers, and now they do philanthropies. They work for not-for-profits, or they've retired. I bet you many of my peers have retired before me. I'm 63 years old, and I'm still working. So
I see. So you think that environment sort of propelled you as well, because you were in like a constant state of competition, especially with a lot of people that were all trying to get the same job?
yeah, I'm a very competitive person. I like to compete. I like to win. And so, sometimes it's very subtle, and sometimes it's much more obvious that people are competing. What was nice was that we had case studies, and so everybody learned to compete as teams. It wasn't all man on man, and that's helpful. And same with our internships. Made some really good friends while I was an intern, and have kept up some of those relationships over time. So you end up with just kind of pockets, but life gets so busy. I've got 4 kids. I have 14 grandkids. I don't have a lot of time for friends. I have some time for friends, but I don't have a lot of time for friends. I have just too many responsibilities. And so, sadly, you kind of keep up with Facebook, LinkedIn, sending a text or an email. So,
Oh yeah. So you mentioned that there is a lot of smart individuals around you, and that if they worked hard, they would definitely surpass you. Do you think that hard work and like someone needs hard work and talent to succeed in this field? Like, how much does hard work provide you over talent in a field such as finance?
makes up for an awful lot. And, when we were building our business, we basically just had the mentality, we cannot afford to fail. And so we knew that we were smart. We knew that we could come up with ideas and solutions, but that's not enough. You got to be willing and able to work hard. And so my partners and I worked really hard. It was not at all uncommon for me to end up being on the road for 5 or 6 days in a week. I was flying all over the world. For a period of time, I was flying around the world every single month. And we did, we outworked many, many people. And I tell my friends, I teach at a college campus, part time, and I tell the students, if you work 80 to 100 hours a week the first 5 years, you gain 10 years of experience in 5 years. Knowledge compounds just like interest, and the more knowledge you get, the better off you'll be, and the faster you'll move up the chain and succeed. And so that's what bosses are looking for. It doesn't mean that you have to throw away your life and work 100 hours a week forever, but when you're paying your dues and you're really kind of learning an industry, what you do in your free time matters. And so I tell people, I need you for 60 hours a week doing all of these things. If you don't know enough about our industry, you need to be studying at night and on weekends. You need to get your CFA. You need to, get credentials before you turn 40 so that you will be an expert by the time you're 40, and you'll have identified your career path and your job, and you'll be able to really take off.
I see. I think that's overall great advice. But leading back to earlier, you mentioned that you founded, I believe it was Portfolio Advisors.
Yes.
So I was wondering how, after it was acquired by, or after you merged with FS Investments in 2023, how that overall like restructured the company and changed the role as a founder.
FS Investments is a terrific company. when they approached us, we weren't for sale, and they approached us and they said, we think that the combined companies can be a real powerhouse in the industry, and this is why. And they basically explained that they had very significant presence in the 40 Act in the wealth space. And so they sold their products through Morgan Stanley, Merrill Lynch, UBS, and others. And they had an excellent suite of products with a terrific leadership team and a very large marketing team. We were in the institutional side. And so they said, we would like you to become our institutional investment arm. We think that as a firm, having both institutional and retail wealth assets, we will be a better and stronger firm. There were many products that we had that we were selling to institutions that would also be very desirable on the wealth side. And so when we thought, how might we grow our company? And as I looked out into the future, since I was kind of the chief strategist as the managing member of the firm, it became kind of increasingly clear to me that if we wanted to double or triple our assets under management, we weren't going to be able to do that in the US institutional market. Many people, most people who wanted to be in private markets had already come into them. They'd already increased their allocations to about the limit they were going to do. So we had a lot of growth while people said, oh, this is a new asset class. We should add that to our mix. Or we have 5%. Now we're going to move to 10 and then to 15 and then to 20. But we didn't think that people would increase their allocations sufficiently so that we would be able to win, double our market share. And so we thought we can grow internationally. So we opened an office in Hong Kong. We opened an office in Singapore, opened one in London, opened one in Zurich. We've since opened one in Seoul, Korea. And we said we can grow internationally because people in many of these places don't know us well, and we think that we can win share there. But after talking to Michael Foreman at FS, it became increasingly clear to me that there was a great opportunity in the wealth space. And you didn't have to look very far to see how much Blackstone has raised, and Ares and Blue Owl and Partners Group and others. And we said, okay, this is a growing area and it's massive. It has a lot of adoption that's going to happen. We can move into that space, and partnering with FS, who already has all of the distribution channels and a very strong reputation for back office services and everything, would be a way for us to significantly increase our AUM through an entirely new channel. And so we got to know the people, really liked them, had great respect for them, and we decided to merge our firms.
Wow, that's definitely an interesting process that you guys went through over the last year. And I'm sure it's going to have a lot of positive effects in the years to come. So, actually, touching back a little bit on your career path, I had one question. So, you went first into investment banking, and then after that, you explored your interests and pivoted into private equity and finding portfolio advisors. So, what were some things that you learned from pivoting out of investment banking, and what would you recommend today? Would you say that it's still a good idea to first start off with investment banking for a few years and then like really specialize, or would you say that it's best to specialize early on?
Investment banking is a wonderful training ground. I mean, I have friends that have been there their entire careers and they love it, and it's a great career. But there are many who say, I would like to do this as a way to prepare for something else. A very common path is for somebody to graduate and go work for a consulting firm or an investment banking firm in one of their analyst programs. And what you learn in those is a lot about industries and about what makes companies successful, and you learn how to model. And so in our firm, all of our direct investment businesses like to source their new talent out of these investment banks because they require far less training. They know how to work hard. They've already been selected out of very top candidates, and they're able to usually hit the ground running and be able to work at a very high level with us. And so, they tend to join us as senior associates or vice presidents. And so we found that to work very well. There aren't a lot of analyst jobs in investment management or private equity. There are more now than there have been, but there still aren't a ton. But there are a lot of consulting jobs and a lot of investment banking jobs. And so that makes it a fairly common path. We now do have training programs as our firm got bigger. We started to hire more analysts, and we would train them, and we would do more promoting from within. But we still do a lot of lateral hiring from the outside.
Okay, so that makes sense. So definitely having some investment banking background isn't gonna be harmful. That's definitely a good way to start. And
It's not mandatory. It's just a good way to start.
yeah, yeah, I think that's really good information. Like especially for me and like other people who are interested in finance, because I know like my personal situation right now that I know I want to go into finance, but I haven't been able to pinpoint exactly where. So maybe going into investment banking will give me some experience and more time to decide. So I actually
Sometimes
had
just one thing. When I got into investment banking, many of these banks have training programs, right? So even though I was at an investment bank, they were affiliated with a big bank, and so I did advanced credit training. That was really helpful to learn that. But I also did a rotational program. So I rotated through the merchant banking group, the leverage lending group, the leverage leasing group. I worked in the restructuring reorganization advisory group, and the loan syndication group. And so you get to spend 2 or 3 months in lots and lots of different places, learn a lot of different things, meet a lot of different people. And then you kind of had a discussion as to which one do I think I'd like to get placed in, and are they interested in having me? So it's just a great way to sort through a lot of things and say what really fits my skill set and my interests. And so that's one of the reasons why it's a nice place to start, because these tend to be very big, very diverse hiring organizations.
Okay, that makes sense. Yes, thank you for that information. Now, I had a little question that's a little bit unrelated to what we've been talking about so far. But considering the current economic environment, and we've seen the Fed recently lowered the interest rates by a half percentage point. So there's been a lot of discussion going around on whether the Fed, like how fast the Fed is going to decrease the interest rates, and whether it's likely that if they do it too fast, there could be serious implications for the economy. So I was wondering your thoughts on this and anything you wanted to share about this.
I'll say I'm not an economist, but I was shocked at how high interest rates got and how long they stayed high. And it makes investing much more difficult because there are an awful lot of models that don't work when you're paying 9 and 10% interest. And so, you really had to make up for using more equity by finding companies that could grow faster or that you can improve margins more significantly. And so, it was a new game for many people who had only invested in a low interest rate environment or an environment where interest rates were going lower. Rising interest rate environments are a different animal, and people had to get used to them. And many people are very capable, and they did. Um, I'm certainly hoping that they go down. I think that it's hard on the economy. It's good for savers. Savers have been beaten up for a very long time. When my parents retired, they thought that they could be very comfortable on a couple $1 million of retirement. Not when interest rates at 1 and 2%. And so having higher interest rates somewhere that's in the middle is very helpful because it's kind of win-win. I don't ever expect that they're going to get back down to where they were. Certainly not in my lifetime. And I have a mortgage at 2.5% interest. I never dreamed I'd have a mortgage. My first mortgage was 9.5%. So that makes a huge difference in how much you can afford and the mortgage payment that you have on your property. Um, but it kind of flows through the entire economy. And so I hope that they come down another 2%, maybe 3%. But if they're kind of 4, 5, 6%, then you get the best of all worlds. Retirees can still afford to retire, and business is not as crimped. But working capital and the cost of capital in a business, lots of projects were done at low interest rates that make 0 cents today, and so people have had to learn to adapt. So I think there's always change going on in many different sectors of the economy, and interest rates are certainly a big driver of that, and tax policy. So
I regarding interest rates and in general, just economic factors, I was wondering how they affect the way you go about your job and sort of manage.
Portfolio Advisors. So I'm no longer the managing partner of Portfolio Advisors. When we merged with FS, I became a senior advisor to FS Investments. And so I see things that are going on at Portfolio Advisors, but I no longer am involved in their management. The Portfolio Advisors is involved in lots of different asset classes. And so you think about lending. So they have senior lending and junior lending. they tend to lend money based on a spread to one of the indexes. It used to be LIBOR, now it's SOFR. And so, they might charge 400 basis points over or 500 basis points over. So as interest rates go up by 3 or 4 or 5%, they're charging more for their loans. It's harder for companies to pay that interest because they have to be that much more profitable in order to do it. But what we found is that if you're working with the best companies and you can lend money at 8, 9, or 10%, you can generate a very attractive return. I mean, think about it. Over the last 100 years, the S&P has a return that's, within 1% of 10%. So it's 9 to 11, depending on which index you're looking at. If you can make senior loans and earn the same rate, that's a pretty compelling opportunity because it's a lot less risky. We see junior debt where we have people that are lending money at 10, 11, 12, 13% interest, and they're also buying a piece of the equity of the company. Those, again, I mean, junior debt funds can outperform over 50% of the buyout funds and have much less risk and be much more structured because you own loans instead of equity. So certain market conditions make certain strategies really interesting. And so right now, there are people that are favoring private credit over private equity because they're able to accomplish the return objectives without having to take equity risk. As interest rates come down, then the credit strategies will be less attractive because they will have lower returns and the equity returns start to get better. And so one of the reasons why we developed a diversified firm was that we always wanted to make sure that we had products that were well placed and attractive in any market condition.
So you're obviously very experienced in this field. So having spent so much time in the private equity space, uh, what major shifts have you observed in the industry over the past, say, 20, 30 years?
There have been a lot of changes. All of the market has grown significantly. The whole asset class is up significantly over the last 30 years. I mean, compounding at a very attractive rate. So, today there are hundreds and hundreds of billions of dollars that can be invested every single year, and there's trillions of dollars that are in the asset class. When I started, it was very common for an institution to have an allocation of 1 to 3% of their portfolio in, say, private equity. We have clients now that have 20 and 30% in private equity. We have some that have over 50% in alternatives. When you add private equity and private real estate, private credit, and hedge funds, they're well over 50%. So the comfort and the knowledge of these assets has grown significantly, and as a result, the asset class has grown very, very significantly. That means there's a lot more jobs. There are a lot more people that do it well. Sadly, there are also a lot more people that don't do it that well. That's just how things work. If you start to rank in quartiles, someone's always got to be in the bottom quartile in the bottom half. But many people have found that even if they have a top half portfolio, that they're able to beat the public markets. And clearly, if people are able to get into the top quartile of managers, then they've been able to beat the public markets by 3, 4, 500 basis points. And that does wonders for a pension fund over a long period of time. That's why we think it will continue to grow. Private credit has come on really strong. It was a relatively new segment of the alternative space, and now it represents a meaningful component every year of the fundraising. And that's partly because of major changes in banking. There had been massive consolidation in the US banking industry. I mean, I've seen charts where it shows 300 banks turned into 4. And many of them don't really lend in the middle market anymore. And so private credit has stepped in to provide the bank financing for buyouts and the growth financing. And so it's grown, and it's not going to go the other direction. I don't think the banks will be able to come back into that space. Maybe they don't want to. And so we've seen massive growth in that. One of the really fun parts of the industry is secondaries. If you own a private equity investment and it's not liquid because it's a 10 or a 12-year partnership, what do you do if you need to get out? And so, two banks merge and they both have private equity portfolios and they just can't have the concentration or the exposure that they have. They need to sell some. And so an entire new market has opened up, which would be a secondary market where people can now sell their private assets, private equity, private real estate, private credit, whatever it is. And there are buyers who will make a market there and provide liquidity for those people. And more people are using that market for portfolio management, for if they have major changes, if if they all of a sudden find that a significant decline in their own other assets causes their concentration to be too high in private equity, they might sell into the market to rebalance their portfolio. Our firm started in that space. We did very well. I think we managed about $10 billion in the secondary space, but it's been a really consistent returning asset class. And the reason is you basically say, what are we willing to pay based on what we know today for these assets? And so you're generally buying these assets for a discount to fair market value. You're able to buy them cheaper than you can go in and buy a new company in the marketplace. And so the combination of buying a quality portfolio and buying it for below fair market value combines to create a pretty attractive return. And we've generated about an 18% return per year in that space. And as a result, more and more people have come in, and we have many peers that have done really well. And it's a very big industry now. They raise 100 to 150 billion dollars a year of deals are traded, and so they try to raise that much to take advantage of them.
So something we've been interested in at Westbank, and something we might want to like have other opinions on, is this growth in like passive investing versus active investing. In the recent few decades, we've seen a huge like spike in passive investing. Do you think like this could create like some structural problems in the financial sphere if like these big companies are just being passively bought by this increasingly like huge amount of people who just like they just like can't deal with all this, just like throw it into some like passive ETF or something.
There are a lot of people who are nervous about how much the ETF market has grown because, I mean, effectively, they're just buying the market in certain ratios, and it can cause distortions in price. You look at the top 10 stocks, they're about the only ones that have really gone up. If you look at the S&P, most of the companies in the S&P have been down the last couple of years, but you have a handful of tech stocks, Nvidia and Facebook and others that have driven that market. There's such a large percentage of the index that when they went up, it just drove the whole index up. And so as a result, it's a little confusing to people as to what they should buy. If you're doing a lot of your own market research, you're buying research and you're picking great companies, but they're not going up. And so it encourages people to index. They're just like, I can't figure this out. I'm just going to buy the index. And basically what they're doing is they're buying the FANG stocks or the top 10 stocks. And they will live and die based on how they perform when they're in those kind of market weighted indexes. Some people like that. Some people don't. It does distort the market if you have really, really big indexes because they aren't thinking. They're not using price discovery. They're just buying the same thing over and over again. And there's weakness in that.
Mhm. So do you see this like, I guess you could call it a bubble of sorts? Do you see this like crashing anywhere in the near future? I read a bit about like once these people start passively selling instead of passively buying, like all of this may like come crashing down, but that'd be obviously very far in the future. Do you
That's a
think
real
this?
risk. That's a real risk. The tricky part is there are many, many active managers who don't earn what they charge. And so there are many, people that say, look, just buy an index, pay 5 basis points, and just own the market. The US market in particular has done extraordinarily well over the last 100 years. Just own the entrepreneurship and the success of the US market. And so there's some real, sense in that. That makes tremendous amount of sense. Why should you pay someone 50 basis points or 100 basis points or 200 basis points? Well, the only reason why you would is if they can consistently add that much or more to the return. And so, there are many managers who are active managers who can't. They don't. Their strategy goes off market and they just can't do it. But then the market turns and all of a sudden their strategy's in favor and they crush it. So, we have the same argument that people make in private equity. We're going and meeting with boards and they're saying, geez, why should I pay you to pick my managers and then I have to pay the managers and the manager charges 2 and 20? That's like a really expensive fee. And the answer is you should only do it if your net return after all your expenses is greater than you would have earned. And so we are judged based on how do we perform versus that public index. If the S&P did 10, how much do you need to earn to make up for the lack of liquidity in your portfolio? And we've had many clients that through their analysis with their consultants have said, if I can make 200 to 300 basis points a year, extra return just by giving up the liquidity, since I don't need liquidity in my entire portfolio, that is sufficient return to compensate me for being illiquid. And, like I said, an extra 2 or 3% matters. A 7% returning portfolio doubles in 10 years. A 10% returning portfolio doubles in 7 years. So when you go out 30 and 40 years, the number of doublings significantly increases, and then you get tremendously different outcomes. So
Wow, that's pretty interesting, I think. That's so looking into the future, do you think new technologies such as AI will drastically affect this evolving landscape of finance?
it has to. Um, I mean, AI can analyze so much data from so many places so quickly. I don't think it will take over all investment analyst jobs. I think it will augment and complement what people do. But now an analyst can analyze 50 times more or 100 times more and then use judgment, because I think there is a lot of judgment. So I've never been concerned that AI is going to replace the really, really high end jobs. I think that it will augment it. People will use it as an additional tool. Do I think AI is going to allow the trucking industry to potentially be all auto driven? Yeah, I think there's a real risk there. Will you potentially not need taxi drivers anymore because Uber can tee up with Tesla and have self-driving taxis? That's a very real risk. So there will be some segments that can be meaningfully disrupted. And I think there will be other segments that will be meaningfully enhanced. And I think the asset management space will be meaningfully enhanced. I think people like to have client service from a human. It's not bad to have an Autobot that helps you set up your calendar, but if you got all your net worth with an organization, I think mostly people will want to talk to a trusted face and potentially a friend.
So something else I was interested in is if you could recommend one book or video to anyone interested in the world of finance, what would it be?
Um, one of the people that I know that I've invested with that's always impressed me with his view of the markets is Howard Marks. Um, and he had a book, I'm going to get the title wrong, but it's like The Next Best Thing, or it's all about risk. And so he talks about how we as humans are really poor at understanding and managing risk. But so much of investing is the management of risk. You need to know if you know enough about an investment, when you need to increase the position size and when you need to reduce the position size. And many times you need to reduce it to zero because the return potential is just not worth the risk. Warren Buffett says that it's only risky if you don't understand it. And so if somebody's truly an expert in a space, then they might find that it's a very attractive investment and everybody else is scared to death by it, but that's because they don't truly understand it. The question is, do you truly understand something, or have you convinced yourself that you're an expert and you really are missing some very critical variables? And so Howard Marks's book, I think it's The Next Best Thing, or the most important thing. I think that's it, the most important thing. I read it, I gave copies to all my kids, and I just said, this is just a really important framework that you need to think through, because understanding risk and taking the right risk and not betting the farm and proper diversification and all those things all fit together in a risk profile.
I see. That's pretty interesting. But so yeah, I have one more question, kind of linked to the AI part. And I was wondering if AI, do you think tools like AI tools would benefit like returns or like increase returns in asset management?
I think that they will help them, because if you can analyze more things deeper and faster, then you should be able to increase the quality of your decisions. Increased quality of decisions should be reflected ultimately in returns. So
I see. Okay, that makes sense. All right. Well, I think we only have a few more questions. Yeah, we have two more questions. One more thing I was wondering, from a professional's point of view, I was wondering what someone like you thought about like generally like retail concepts, so things like day trading or technical analysis. I wondered if you thought that had any like real foothold.
I think AI will make that much better. I mean, I know people that do technical trading, and you're basically comparing historical data and coming up with trends. And the more data you can analyze and the more correlations you can look for, the smarter you should be able to be, and the better investor you should be. So I think that would help, and that would also help for day trading. I've had friends that have tried to do day trading, and when they're kind of in one industry and they decide they want to do day trading, whether it's in stocks, whether it's in crypto, whether it's in whatever, um, most of them find that they do really, really well in major bull markets, and then they lose all their money when the market conditions change because hubris kind of creeps in and they think, I'm so good at this. I'm going to quit my job and I'm going to put all my money into the market and I'm going to be able to live on my trading profits. Um, some people have been successful at that, but many people have failed.
Well, Mr. Murphy, it's been really interesting listening to you talk. I think I personally have learned a lot. I think Conrad and Neil probably have too. So we have one final question for you. So in today's society, what key pieces of advice would you give to a high school student who's interested in entering the world of finance? So you mentioned maybe like not being shy, I guess improving on your communication. What what key piece of advice would you give to people today?
I think you guys are off to a great start. First of all, the fact that you're not shy, that you're willing to make an ask, the fact that Neil contacted me and was very professional and very persistent. We got this set up and we're able to do it. Um, I think is a really good start. I met Neil through the Young Investors Society. That's a terrific training for kids that are in high school. And it was interesting. A friend of mine was the global head of research for a major investment firm, and he became a board member and a judge. And he said, Brian, you need to come and get involved in this because these kids are putting out research that's as good as some of my associates and analysts when I was on Wall Street. And so people are getting involved earlier, they're learning the rules earlier, they're mastering a craft earlier. And I think that's all terrific because, again, it's like I said, knowledge compounds just like interest. You're starting earlier, and so you will become an expert earlier. And that's a tremendous, kind of credit to what you're doing. Make sure that you get internships and that you test yourself, that you see different things. When I teach on campus, I always tell people, take the hard job. If you do something that everyone else can do, it's really hard to differentiate yourself. One of the reasons why I moved into turnarounds was because it was ugly and it was hard and there were so many complexities. But if you did it well, if you learned how to do it well, you would stand out and you could solve problems and let people know you're a thinker, that you're a problem solver. And that will get you noticed and that will get you promoted. I always tell them, figure out what you need to do to get your boss promoted. If you figure out what your boss needs to do to get promoted and you work really hard to help them get promoted, things usually go well for you. You usually get pulled along with them. You might move into their spot, and that's great. Now, the last thing I tell them is don't spend so much of your time thinking about how much money you make until you turn 40 years old. Spend your time getting all the tools and the credentials and the knowledge. When you turn 40, if you know what industry you want to be in, if you know what job you want to be in, maybe you're already in it when you turn 40. Most of the compensation you will earn in your life comes after 40. When you're in your 20s and early 30s, you rarely have any extra money because you're buying a house and you have a family and you got kids and there's so many things that cost. But as you get older and as your compensation grows, you hit what I would call escape velocity. Think of a rocket ship. Once they break out of the Earth's atmosphere, they hit escape velocity, and the speed at which they go and the ease at which they fly through space is much easier. When I think about that in my life, as soon as I hit escape velocity, I was able to dedicate a much greater percentage of my income, disposable income, to investing. And I was able to watch my net worth grow. But that was because I positioned myself so that I would have the best part of my career after I was 40. I know a lot of people that jump brands and they move jobs because they make an extra $5,000 or $10,000. That's not smart unless they're going to move to a place where they're going to learn new skills and they're going to be that much more capable in solving problems and developing in the organization. So that's what I always teach the students.
Oh, okay. So I guess one thing that I've heard a lot is that when we're young, just like put yourself out there, try new things, get knowledge. Like you said, knowledge compounds like interest. So just like try stuff, right? I guess.
Yep. Don't be afraid to ask.
Yeah.
You'll be surprised what people will do.
All right, cool. So that concludes our interview for today. Thanks again to Brian Murphy, to our listeners as well. And
I enjoyed being with you.
Yeah.
Thanks very much for spending your time with me.
you, I guess we should be saying that to you, but yeah, thank you very much for joining us today.